morning, everyone, and welcome back to our weekly webinar series. So today is our episode number 144. We're talking about intricacies of IBC and Income Tax Act. Over to Anil sir.
Thank you, Ankit. Welcome to 144 weekly episode of AAA Weekly Webinar Series. You see, in the last couple of years, we have seen that the resolution plans are getting approved and a new kind of opportunity is coming to the professionals who understand IBC as well as income tax law. Because the resolution applicant, the successful resolution applicants are struggling to understand the tax liabilities prior to commencement of CIRP, during CIRP, and after the resolution plan is approved. Section 41 subsection 1 and section 28 subsection 4 of Income Tax Act are even creating more noise and a kind of stress to these successful resolution applicants. Various consultants are coming with various kinds of solutions. For example, assignment of debt, taking over the company in a SPV or a hybrid method. So when it comes to the actual calculations, what is impactful is we have to understand the implications of Section 79 of the Income Tax Act, Section 115JB of the Income Tax Act, various amendments made by the Income Tax Department to facilitate successful takeover of the companies. All this is becoming a very, very kind of issue in vogue. Therefore, we decided to do this episode purely focused on income tax vis-a-vis IBC. So what we started looking into the various amendments made by the Income Tax Act, made in the Income Tax Act since the inception of IBC. And then we also will look in case the time would be available, then we will also look into some recent judgments only and only on income tax issues, like whether the income tax refund would be available, whether there is a possibility of set-off or not. And the more focus would be on why these provisions are made. So how the thinking process of the government is going on as of now. Starting with, we would like to see the various amendments through union budgets. First, we will see what were the amendments in Union Budget 2018, because see, that was the first, I believe, when a lot of representations might have gone to the Ministry of Finance to tweak into certain sections of the income tax law, which is not merging with the intent of the IBC. So therefore, the first Union Budget 2018 saw a very, in fact, good two changes. One was in Section 79 of the Income Tax Act regarding carry forward and set off losses in case of certain companies. So in fact, when we see in general, this section provides that in any previous year where there is a change of shareholding representing more than 49% of the voting power of the company, in which the public is not substantially interested, the loss of any year prior to the said previous year shall not be allowed to be carried forward or set off. It was noticed by the government that in the case of resolution plan getting approved after Section 29A, there will be a possibility in most of the cases that the entire shareholding or part of the shareholding is changed, and most of the cases, rather 99% of the cases, will fall under this category of Section 79, where there is a restriction of carry forward and set of losses that not more than 49% of the voting power of that company shall not see in case the change is not more than 49%. In insolvency, most of the companies will have a change of the shareholding representing more than 49%. Therefore, this particular benefit was given to the uh, successful resolution applicants, and a proviso to Section 79 was inserted by Finance Act 2018 that the provisions will not be applicable to the companies where a change in shareholding takes place in a previous year pursuant to the approval of resolution plan under IBC 2016. The proviso reads, I will read the proviso for you and slowly. Provided also that nothing contained in this section shall apply to a company where a change in the shareholding takes place in a previous year pursuant to a resolution plan approved under the Insolvency and Bankruptcy Code 2016 after affording a reasonable opportunity of being heard to the jurisdictional principal commissioner or commissioner. Now, this applicability of this proviso is further having a one action which is required after affording a reasonable opportunity of being heard to the jurisdictional principal commissioner or the commissioner. We have seen in most of the cases when the resolution plan is submitted to the when a resolution plan is submitted to the adjudicating authority, we have seen that the jurisdictional principal commissioner or the commissioner of income tax is also made a party to it. So in that case, in case we make them a party to it, then the resolution plan also has to be submitted to them as the copy of the application that we make under Section 30 of the IBC will also have the resolution plan approved by the Committee of Creditors. So therefore, this was also a difficulty that the resolution plan is going to the principal commissioner. Then later on, we saw that the notice from the NCLT is also getting issued to the jurisdictional principal commissioner of the corporate debtor. However, in many cases, this particular action is not taken. And maybe that after the resolution plan is approved, it can also be interpreted in such a manner that once this benefit of carry forward and set of losses is given at that particular time, and a reasonable opportunity would be given to the jurisdictional principal commissioner or commissioner of income tax. Let us understand what will happen in case this opportunity or has not been afforded to the principal commissioner or commissioner. I still feel that the opportunity, even after the resolution plan is approved, the opportunity would be possible. But in many cases, even if the opportunity has been given, even if the service of the IA has been given to the principal commissioners, nobody is attending to that. So therefore, we are presently assuming that based on this issue, whether the opportunity was afforded to the principal commissioner or not, the applicability of this proviso would not come under any hurdle. So therefore, we are assuming that if the opportunity is not given in many cases, it would still be considered as the proviso is applicable to the company which has undergone a resolution plan approved by the committee of creditor and also approved by the adjudicating authority. So therefore, now even if there is 100% change in the shareholding of a company, the carry forward of losses and set off of the losses would be available to the companies undergone successful resolution plan. The second amendment was made under Section 115JB of the Income Tax Act. That section says special provision for payment of tax by certain companies, and we also call it minimum alternate tax. In the case of minimum alternate tax, in fact, the clause 3 of the explanation to Section 115JB, it says that the following would be reduced from the book profit of the company. The book profit of the company is subject to tax at minimum alternate tax rate, which is, Ankit, nowadays it is like 30% or it is reduced now. What is the minimum alternate tax rate? Maybe 18%. Anyway, we can see because the rates actually have been changing. Now the amount of loss brought forward or unabsorbed depreciation, whichever is less as per the books of account, is permitted to be set off in computing book profit. That is the existing clause 3 of explanation to Section 115JB. That means that if my book profit is 100 and if I see my unabsorbed depreciation and my brought forward losses, and the brought forward losses would be without unabsorbed depreciation, then the whichever is lesser would be allowed to me as set off, whichever is lesser. And in some cases, if the losses are zero, then zero would be the deduction. And in case the depreciation is zero, then the zero would be deduction. So therefore, this particular clause 3 of the explanation to Section 115JB has not been very helpful to the companies who actually have earned substantial book profit in a particular year. In this Finance Act 2018, just to circumvent this particular provision, which clause 3 of to explanation under Section 115JB, there was a special clause, it was created, which is clause 2H, and that was created prior to the clause 3, which was an existing clause. So clause 2H was inserted, and that on the, see what it says, that on the admission of application to appoint insolvency resolution professional and to initiate CIRP process under IBC code under Section 7, 9, or 10, then the aggregate amount of unabsorbed depreciation and loss shall be allowed to be reduced from the book profit, which shall not include. That means that we have the unabsorbed losses and we have the unabsorbed depreciation. Aggregate of these two for all the earlier years can be allowed to be reduced from the book profit of the company once the admission of an application, once the CIRP is initiated, either under Section 7, 9, or 10. If the CIRP is initiated, then the book profit would not be subject to MAT to the extent of brought forward losses and brought forward depreciation, a sum total of that. So that is what the clause 2H was inserted in Section 115JB, and clause 2H, which was inserted, I can even read for you the aggregate. See now why I'm saying reading clause 2H, because this particular clause, and before that we have to see that the book profit of the company for the year will be reduced by. will be reduced by the aggregate amount of unabsorbed depreciation and loss brought forward in case of a company against whom an application for corporate insolvency resolution process has been admitted by the adjudicating authority under section 7, 9, or 10 of the Insolvency and Bankruptcy Code. So that means the aggregate is allowed. So now this aggregate is allowed even for the taxation purposes during the CIRP. In case the CIRP continues for 2 years, in that 2 years also, that benefit of 115JB would be applicable. It is not only for the successful resolution applicant, but this is also for the RP and the IRP, because there are many cases where some income is being generated, and therefore even that particular year, when during CIRP also this benefit would be available. And for the purpose of this clause, the expression adjudicating authority shall have the same meaning as we have it in the IBC. And this amendment, in fact, is these two amendments are very important. The third amendment, which was done in Budget 2018, was Section 140 of the income tax. Like that section deals with return by whom to be verified. Now, this section provides this section provides the person who will verify the return of income. So in the case of a company, it is provided in section 140 of the Income Tax Act that the return of income will be verified by the managing director. In case there is no managing director, then by any director. However, section 17, subsection 1, clause B says of the IBC, section 17, subsection 1, clause B of the IBC says that on the appointment of IRP, the powers of the board will stand suspended. So therefore, the powers that was given for the verification of the return under the Income Tax Act has actually been suspended. How the income tax returns can be signed during the CIRP? In case the RP is filing any return, it cannot be signed by the managing director or the director of the company. Therefore, the Finance Act 2018 inserted a clause C after the second proviso to section 140C, which reads as, now this was the clause C which was inserted after the second proviso, and it was saying where in respect of a company, an application for corporate insolvency resolution process has been admitted by the adjudicating authority under section 7 or 9 or 10 of the IBC, the return shall be verified by the insolvency professional appointed by such adjudicating authority. Insolvency professional appointed by such adjudicating authority, and all these provisions actually will come in effect from 1st April 2018. That's what we had now got in the budget 2018. So in case we go forward quickly, what exactly happened in budget 2019? In budget 2019, we also have to see what happened in budget 2019. So Ankit, is there anything that we can deal as of now? Is there any question as of now?
Yes, I will share a few things, a few insights. So first of all, the MAT rate is about 15%, and then with surcharges, it kind of increases to 16.5, something like that. So that's one. Number two, these days MAT has become less important because of new sections 115BA, 115BAA, 115BAB, BAC. So these were new sections which introduced an alternative, special rate tax regime, according to which then the tax rate for companies has reduced to 22%. 25% in case of manufacturing companies, 15% in case of new companies which are doing manufacturing. So this way they have introduced these alternative approaches, alternative schemes, under which, of course, if there is any rebate under ATIAC, ATIAB, and all the promotive schemes with taxation, or there was a tax holiday, if somebody does not exercise those, then companies can exercise the special rate. There is also the provision in these special rates that in case somebody chooses this alternative taxation scheme, then MAT will not be applicable or 115JB will not be applicable. So therefore, for any new returns that anyone is filing, let's say example, somebody gets a resolution plan implemented in 22-23, and now that person is filing their returns or had filed their returns before the due date or before 31st December 2025. In that case, that person will of course mostly exercise this option, and MAT will not bother him. But for those years where one cannot fill in the form required to opt in into this 115BA or BAA and other sections, for those years, MAT needs to be planned. So, example, in case the due date for return has passed and one has not opted for the special rate of taxation, then they will be required to, of course, plan for MAT as well. In which case, this relief that was given in that budget, where the unabsorbed depreciation plus losses both were allowed to the assessee company, will be helpful. Now, coming back to the other parts that you shared, I believe that 140, the change where insolvency professional can sign the returns, is just allowing, acknowledging that, okay, this is also a person who can actually submit the return on behalf of the company. But yes, the first change is important, where in insolvency, where if you have a change in shareholding, you can continue to absorb the or use the unabsorbed use the brought forward losses. So that change is a very, very effective change that helps those SSC companies where returns have been filed properly, hold unabsorbed depreciation and losses are available for the last 8 years. So in those cases, that law becomes very effective. And we also need to discuss how, in liquidation as a going concern, this how do we read that provision for liquidation purposes? Because as I understand, that provision is only giving relief for companies under insolvency. So these are the nitty-gritties that I thought I will bring out. We also have two questions.
I will, before the questions, I would actually need one clarity from you. In case of new regime of for the companies, the brought forward losses are allowed or not?
They are allowed.
And the unabsorbed depreciation is also allowed.
So,
So that means even if there are unabsorbed losses, even if there are the uh, unabsorbed depreciation, still the new regime can be adopted.
yeah.
So therefore, the section 2079 is applicable and section 115JB in case of new regime is not applicable. That means
Like there are few exceptions there. I can clarify. So there is a provision in under section 32 which allowed for additional depreciation to be taken
your
on
voice
certain.
is little less today. Maybe that some
I'm
maybe
saying that
yeah.
the additional depreciation that was allowed earlier for new companies which were making investments. So there was a provision which allowed companies to make claim additional depreciation. So now this section like 115 AC or AB will say that additional depreciation, any unabsorbed depreciation which is carried forward because of that section will not be allowed in the under the new regime. So basically the idea is to stop stop the benefits that are special benefits that are taken by the company under these special provisions, whether it is be additional depreciation or ATIC, ATIB, other promotion schemes. There used to be this export. There was a scheme which allowed for export SEZs and export. They used to special SEZs and they was used to export hubs or export provisions. So those are again promotional schemes. So that's not allowed.
So we can actually one that see we can discuss the when the company is being sold as a going concern in a liquidation process. What we do in our prayer to NCLT when we seek the approval for sale of the company as a going concern. In fact, what we seek from the adjudicating authority is the power to change the directors of the company and power to extinguish all the shares and allot new shares because these are the three powers which are not allowed to the liquidator. So therefore, the liquidator they cannot go to the registrar of companies that while this company was under liquidation, now I am changing the directors. So first of all, the liquidation status of the company will have to be changed to active. Then the NCLT will allow us to change the directors. Then the NCLT will change us to issue the new shares and extinguish the existing shares. That is what these are the four steps which are required in case we sell the company as a going concern in a liquidation process. Therefore, our application to adjudicating authority is restricted with these four clauses. And also in another clause that we say that it should also be please mention that this liquidation as a going concern is akin to resolution plan. See, when we say this, and in most of the cases that we have seen approving the liquidation as a going concern, the NCLT also says that yes, it is akin to resolution plan. So that actually will help us when the income tax department will give notice without recognizing liquidation as a sale as a going concern, parallel to a resolution plan, then this order will actually help us.
Yeah,
So this
that's
is
fine. But then if you look at the definition again, that definition very clear that this is in the previous year in which a resolution plan was implemented. And I think it also very clearly says that it is during CARP or right after CARP. We can read that again. But we of course need to see that whether even with some discretionary reading, can we really say that liquidation as a going concern is included in that provision or proviso, which allows for unabsorbed depreciation and brought forward losses to continue to the new shareholders or to the new director, to the new management.
Yes, I think we are presently depending upon that wording that normally we get from NCLT that this is akin to resolution plan.
Right.
So, of course, we will see when this uh, some notices will come and some assessment
Jurisprudence
will
will
be
form.
done.
Jurisprudence will happen.
Jurisprudence will become later. So you have some questions only on these issues.
So Arun Kumar Srivastava ji is asking whether carry forward of MAT credit is allowed to new company if it opts to reduce rate of 22%. No. So as soon as you opt for the new schemes, any previous MAT credits are also they also lapse along with the liability to MAT for you. But that doesn't really affect you because in case MAT rate is 15%. So I'll tell you where I'm coming from. In case MAT rate is 15% and your income tax rate is 30%, the whole premise used to be that the MAT credit used to come in into the picture in case your book profit is giving you a lesser profit or your MAT is lesser and your income tax is higher. But there now the differential has become too much. The income tax rate is 30% and the MAT rate is 16%. So even if you would have to have very specific facts for you to continue to have an advantage of a reduced tax rate with the MAT credit idea in place. So not that MAT credit can really help you reduce the taxation. Um, but yeah, there can be some circumstances where it is helping. Then we have
But
a
see,
question.
certainly we can answer it in positive in case of the new regime is not adopted. Then the MAT credit, whatever is available to the company, that would also be available after the change in hands. Uh, in fact, in section 5, in section 115 JB, there is no stipulation that all these credits would not be carry forward for set off in case of change in shareholding. That is only restricted to section 79. It is not in section 115 JB. So even if the company undergo a succession and the entire shareholding is changed, maybe because of section 241, 242, or under IBC, the MAT credit would still be continued.
Yes. Then we have a question which says that in the year of implementation resolution plan, whether 115 JB allows to adjust aggregate of unabsorbed losses and unabsorbed losses, and I think he meant unabsorbed depreciation.
Yes, yes.
115 JB, of course, that's what we are saying, that in the year of implementation of the resolution plan, there is an amendment in 115 JB that Anil sir just talked about, which allows for aggregate of this to be adjusted and not the lesser of the two, as it is applicable for other companies.
See,
So
even let's see, when I will discuss section 41 subsection 1 and section 28 subsection 4, I would actually try to say what is the intent of the government. The government is saying that in case the company has incurred losses, and the depreciation, to the extent of depreciation and to the extent of losses, this 115 JB would not be applicable, and also section 79 would not be applicable. So to that extent, even if the liabilities are reduced, even if there is a cessation and a remission of liabilities under section 41, so that would not be taxable, because in case that will become taxable, so that will be completely set off with the unabsorbed depreciation and 115 JB. But if the company has not incurred losses in the past, or the returns have not been filed on time, then there is an intent of taxing the additional write-off, additional benefit under section 28 subsection 4 to tax. So that is the logic. Like, say a company has 1000 crores of book losses and unabsorbed depreciation, and also almost similar to under the Income Tax Act, and to this extent, to the extent of 1000 crore, in case the liabilities are also reduced or seized, then it is tax neutral. However, if the liabilities which are reduced in the succession process, then the government has the intention of taxing it. That's what is the intent of the government. So therefore, although there may be some other assets which also gets kind of written off, and we can even set off with the profits. So Ankit, should we move on, or should we have more questions?
now I think we can move on, and I can we can request the participants that in case you have any questions, you can post them, and or you can raise your hands. We will be happy to kind of make this interactive. Maybe you can continue, and we can have another break for questions after 15 minutes.
Now I move on to Union Budget 2019, and we will see what were the uh, kind of amendments in Union Budget 2019, and we would see the even the facilitating. We are only restricting ourselves to those provisions facilitating resolution of distressed companies under IBC or under any other law. So when in 2018 we saw the amendment in section 79 regarding carry forward and set of losses, and we saw that it is kind of provided a kind of a benefit to the companies. Now it was in fact good that the section 79 was amended. However, it was basically feedback was given to government that this benefit uh, of succession, this benefit of succession under IBC should also be available to other kind of succession, other kind of succession by way of implication of law, like the certain other companies, uh, like the companies where this where the NCLT on a petition moved by the central government under section 241 of the Companies Act has suspended the board of directors of the company and has appointed new directors who are nominated by central government under section 242 of the Companies Act. And also, and also uh, in the IBC process, there may be many subsidiary companies of the corporate debtor, and the successful resolution applicant may also propose that the shareholding of the subsidiary company will also undergo a change, and that is one. And also uh, a kind of uh, a kind resolution plan which NCLT might approve under section 242 of the Companies Act. So these are the issues which were raised by the various interested parties, and therefore in budget in Union Budget 2019, this benefit of Section 29 was extended to other companies, like three kind of companies, when the board of directors of the company is changed under Section 241 or 242 of the Companies Act. This benefit was available to all the subsidiary companies of the corporate debtor undergone a resolution plan approved by the Committee of Creditors and by the adjudicating authority. However, this opportunity of being heard to the jurisdictional principal commissioner or the commissioner is continuing. Similarly, this benefit of Section 115JB, which was given in Union Budget 2018, based on the feedback, this benefit was also extended to the subsidiary companies and those companies which, in fact, got into a succession change in the shareholding only because of Section 241 of the Companies Act, 242 of the Companies Act, and also for all the subsidiary companies. So therefore, this benefit was in fact extended to these few companies also in 2019 Union Budget. So therefore, it was said that then there was another provision, in fact, which was kind of creating some hurdles, and that was the Section 56, subsection 2 and clause 10 of the Income Tax Act, which is for the buyer of the asset or shares of a company. And then also similar section, which is Section 50, capital C, capital A of the Income Tax Act, and that is a provision for deeming of the fair market value of unquoted shares for computing the capital gain from the transfer of such shares. So the Section 50, capital C and capital A is applicable to seller of the shares for the purpose of calculating capital gain. However, Section 56, subsection 2, clause 10 is applicable to any person as income from other sources, because the Section 56 is primarily for the transferee, basically for the transferee. Even in this particular Section 56 to X, it actually also means that if shares of my company, shares of a company is subscribed by shareholders, and the fair consideration is say 20 rupees per share, and if I get the subscription at 100 rupees per share, then 100 minus 20 rupees 18 is also taxable in the hands of the company who is getting the share subscription in it. So Section 56, subsection 2, the clause 10, income from other sources, would consider it as income. Similarly, Section 50, capital CA for the transferor. Now, in insolvency, this particular section was amended, and it said that it is proposed to amend these sections to empower the board. That means CBDT. It is proposed to amend these sections to empower the board to prescribe transactions undertaken by certain class of persons to which provisions of Section 56, subsection 2, clause 10, and Section 50, capital C and capital A shall not be applicable. So these amendments, in fact, would be applicable, and it was applicable from 2020-21. So this is where I am trying to say that these two hurdles also were, in fact, removed, and then finally, I think the rules and the notification came, and it was such kind of transactions were notified. We'll come to that. We will come to that such kind of notifications were also done. Then I think I have that notification on. Yes, there are two things that I have, but then that is not applicable. That is not here. In fact, but I'll look into that slightly later. And then we move on to the amendments done in Union Budget 2020. In this Union Budget, in fact, a little on the basis of the feedback that often on, like, the government is supposed to make an amendment, like who will be authorized to sign the balance sheet or not. So therefore, the amendment under Section 140 was again made. Section 140 actually it empowers that either the return will be signed by the MD or a director, or in case of the company under insolvency, it will be signed by the insolvency professional, or in the case of limited liability partnerships, it will be signed by the partners. Now, in this particular union budget, this particular section was changed because, see, in Section 140, in clause C, after the words by any director thereof, the word by any person as may be prescribed for this purpose shall be inserted, or it was inserted. Now, this amendment was also effective from 1st April 2020. Similarly, in this Section 288 of the Income Tax Act, which provides for the persons who are entitled to appear before any income tax authority or the appellate tribunal on behalf of the assessee as its authorized representative. No, one is the authorized representatives who are otherwise qualified professionals, and they are the authorized representatives of the companies getting the assessment or before the income tax department. However, in case the authorized representative has to be other than that professional, then the IBC empowers the insolvency professional or the administrator to exercise the powers of the board of directors. No, either the board of directors are authorized, or or even the authorized professionals are authorized to appear before the income tax authorities. However, the Section 288 was not specifically, it was not referred. So therefore, specifically, it was amended that the insolvency professional also can be an authorized representative. So therefore, this time, in this particular year, it was mentioned any other person as may be prescribed. And when we see these two prescription came, these two amendments finally it fructified by way of a notification which came on 18th August 2021 from the CBDT, and it was a kind of amendment to income tax rules, and that amendment was seen in Rule 12AA, prescribed person for the purpose of Clause C and Clause CD of Section 140. That means for verification of an interest, for verification of return of income. So in this rule, they provided that the other person shall be the person appointed by the adjudicating authority for discharging the duties and functions of an interim resolution professional, a resolution professional, or a liquidator, as the case may be, under IBC. And similarly, in Rule 51, capital B, was inserted appearance by authorized representatives in certain cases. So here also, for the purpose of Section 288 of the Income Tax Act, any other person in respect of a company or a limited liability partnership, as the case may be, shall be the person appointed by the adjudicating authority for discharging the duties of and functions of IRP, RP, or the liquidator. So these were the two amendments in the rules that we have seen. So that is only consequent to Union Budget 2020. So now what we can conclude, the returns are supposed to be signed by the RP, IRP, or the liquidator in case it is required. And therefore, the intent of the income tax department is very clear, that they want all the compliances to be done by the RP, IRP. So that actually is not something that we can avoid. It has to be done. Then we move on to the amendment that we actually have seen in Union Budget 2022, that is regarding the successor entity subsequent to business. So this amendment is regarding the successor entity, and more or less it is applicable to it is applicable to the cases of merger, demerger, amalgamations, because in the merger, demerger, amalgamations, there is one is the effective date. and after the effective date, for some time, the proceedings are pending before any court, including NCLT, High Court, or any Supreme Court, and the amalgamation, merger, or demerger does not become conclusive till the order of the court is received approving the reconstitution, approving the reorganization of the company. Therefore, what is happening practically? That from the effective date, all the risk and reward has already been shifted to the successor company, whereas approval has not come. Therefore, the returns of income tax are being filed by the predecessor. The returns of income tax are being filed by the predecessor, and the responsibility lies on the successor, because the effective date is 1 or 2 years prior to the actual date of the order. In some cases, it may be more than 1 or 2 years because of the litigation before any court, High Court or Supreme Court. Therefore, the in this particular budget, this was amended. Section 156 capital A of the Income Tax Act was amended. It was amended that in case any return has been filed by the predecessor, the successor will have the right to modify the return after the order of NCLT or any court or a Supreme Court, and that modified return will finally become the return, and that would be assessed. And if there is any demand, which is already created based on the return filed by the predecessor, that demand also would be corrected. The assessing officer under Section 156A and under Section 170 of the Income Tax Act will modify that demand, and that demand also will be finally a modified demand based on the modified return. That is also one of the very, very important kind of change in the case of business organizations. So the also, like it was kind of in that budget, we also could see, because when I was searching, so I could also see that in the budget speech, it was said by the Honorable Minister of Finance that the necessary amendments in the code will be carried out to enhance the efficacy of the resolution process and facilitate cross-border insolvency resolution. So therefore, accelerated corporate exit was also proposed. Several IT-based systems have been established and accelerated registration of new companies. Now the Center for Processing Accelerated Corporate Exit, CPACE, Center for Processing Accelerated Corporate Exit, which is CPACE, with process re-engineering, will be established to facilitate and speed up the voluntary winding up of these companies from the currently required 2 years to less than 6 months. That was also Center for Processing Accelerated Corporate Exit was also set up, and it has now been set up. Probably it is actually located at the Indian Institute of Corporate Affairs, Manesar. So I think that also actually can help in the case of voluntary winding up of the cases, voluntary liquidation of the cases. So these are the amendments in budget 22. Now I move on to the most important amendment, which is in budget 23, and regarding the business organization, that we've already seen, that the modification of the return and modification of the order under Section 150, 170 capital A is the modification of return, and the Section 156 is the modification of order and the demand. Then we also have another important part, that is the decriminalization of Section 270 capital A of the Act, because in this particular Section 276 capital A, it is also mentioned that in case the liquidator fails to set aside the amount as required by subsection 3 of the said section under section 178 of the Income Tax Act, then the liquidator will also be subject to an imprisonment of up to 2 years. However, the government then finally thought that now the government has actually uh, uh, in the code the priority of the payment of taxes has already been provided. Therefore, the liquidator is not supposed to give priority to the payment of taxes. Therefore, Section 178, as presently it exists in the Income Tax Act, is not applicable to the liquidators. So the consequential amendment in Section 276, capital A of the Act, which actually provides for imprisonment in case provisions of Section 178 of the Income Tax Act are not complied with. Therefore, Section 276A, which is regarding the imprisonment prosecution, that should also be changed. So therefore, it was also changed, and it was changed that no proceedings under this section will be commenced after first day of April 23, and even before, like once it is done. So that also has actually been a good change, and it is actually something which is really important to understand, that the government is very actively considering all these amendments. Then Ankit, any questions that we can have, or we can shift to some other kind
I
of.
think 28, I think some focus on 28 4 is what we
Yes,
talk
I
about.
think this 28, I can section 28, subsection 4, this amendment was also made with effect from 1st April 24. It was made in Union Budget 23. Now, what it in fact came, it says that the value of any benefit or perquisite arising from business or the exercise of a profession, whether A, convertible into money or not, or B, in cash or in kind, or partly in cash and partly in kind, that will be something which will be taxable under section 28 subsection 4 of the Income Tax Act. And see, earlier it was the, although the no, it seemingly it is not making much difference, but in budget 23 when it was inserted, and it actually it proposed an amendment and saying, and it was only done to circumvent the impact of a Supreme Court judgment in the case of Mahindra and Mahindra Limited, and that was done in 2018, and wherein it was held that in case of a loan waiver, generally accounted as income by crediting the profit and loss account, since the benefit is received in cash or in the shape of money, the provisions of section 28 subsection 4 would not apply. So therefore, to circumvent and because of this judgment, since 2018, all these loan waivers were not being taxed because of the Supreme Court judgment, and therefore the amendment came, whether convertible into money or not, in received in cash or kind. So that is the only amendment that they made, so that this impact of this Supreme Court judgment in the case of Mahindra and Mahindra in 2018, which was given by, so that should actually be circumvented. In the meantime, Section 194R was also inserted a year before, and saying it was introduced in the last year. Last year means it was introduced in 22. It was introduced in budget 22, providing for TDS on benefits or perquisites arising out of the business or profession. Now, the language which was used in section 194R, that was also similar to section 28 subsection 4 of the Act. Therefore, it was understood widely that TDS would be applicable under section 194R. It will be applicable to the benefits of non-monitoring nature because of the Mahindra and Mahindra. However, after this amendment, the Central Board of Direct taxes gave a circular and a guidelines and to provide clarity on the application of Section 194R of the Act. And in the said circular, it was mentioned that the provisions of Section 194R would be applicable to the perquisite or benefit in cash as well. It was further mentioned that the principal amount of loan waived, being a benefit to the borrower, would also be covered under Section 194R. So therefore, the 194R, followed by CBDT circular, followed by amendment under Section 928, subsection 4, basically a kind of discomfort to the taxpayers that this TDS would be applicable, and Section 28, subsection 4 would be applicable to all kind of loan waivers. That comfort actually came, and then the so the amendment also kind of is very, very important. Although some tax consultant says that the CBDT clarification cannot go beyond the Act, or even the circulars also cannot go beyond the Act. So that actually Section 28, subsection 4, and when we see Section 41, subsection 1 of the Income Tax Act, that is regarding cessation and remission of liabilities, and that is supposed to be taxable. Now, in this scenario, Ankit, let us now try to understand what we normally do for arriving at the tax liability under Section 41, subsection 1, and under Section 28, subsection 4 of the Income Tax Act, and also 115JB. Now, what exactly Section 41, subsection 1 says? That any expenditure or loss would, and if it has been allowed, as an expenditure or as a set-off from the income of a SSC, and later on, any liability created because of that expenditure or loss is seized, then that cessation of that liability would be taxable. Now, when we try to see, there are many items which already we disallow under Section 43, capital B, and we, when we take over a company, anything which is already disallowed, for example, in trust to financial institutions, banks, in case we don't pay, it is disallowed under Section 43B, workman liabilities, MSME payments, and many other things which are already disallowed because it was not paid. So therefore, there will not be any double taxation on this when that liability will cease to exist. Similarly, there may be certain, but then Section 41, subsection 1 was restricted to something which has already been allowed. But with the insertion of 28, subsection 4, in case of any term loan that I have taken, see what we used to interpret, like when I have taken a loan and I have utilized that loan for the purpose of setting up an asset, setting up a capital asset. Therefore, I have not claimed this amount of loan. This liability has not been created against any kind of expenditure or loss that has been allowed to me. So therefore, when this loan is getting waived, it was not taxable because this particular loan was not in any manner used to claim any loss or expenditure. However, when I was borrowing for working capital, means that I took the disbursement against stock. I purchased the stock or debtors. The stock was capitalized in the books of account. The stock was claimed as a purchase in the books of account. And then later on, if that working capital loan is waived or written off, then it is taxable under Section 41, subsection 1. But now, under Section 28, subsection 4, everything is supposed to be taxable. Yes, Ankit, let us come to the discussion in case there is any questions or any discussion from the audience. Not audible.
So I was saying that Ram Kumar ji, Ram Kumar SV, he is saying that he of course asked for 28.4 clarification on that, and how after that what is the kind of taxability in the books of accounts, and you've already clarified that. The only thought process, Ram Kumar ji, here that we kind of keep sharing is that 28.4 can tax those write backs or those write backs which are one, not set off against any corresponding write back, write off. Number two, if there is any past disallowance under 43B, under 40A for non-deduction of TDS, any other past disallowance, that disallowance cannot, in our understanding, be double taxed, because the on the other side you're also reversing the write back.
That's
The
what we are
because
saying. We also
Yeah.
decided that, Ankit. Mhm.
So then we have another question which says that whether 115 JB benefit is available where ITRs are filed belated. Yes, 115 JB, there's nothing to do with the
Yes, yes.
filing of the returns. And then there is Arun Kumar ji is asking that whether the capital gain tax will be levied under resolution plan. So when does capital gain arise? Capital gain will arise to somebody as part of a resolution plan in case somebody is getting any money against maybe a security that they are holding, which is for which they are then accountable to pay tax. So in case, let's say, capital gains tax will come into a picture where, let's say, an equity shareholder is getting some money through the resolution plan, and that resolution and that money that he's getting is maybe in his settlement of his holding in the equity share. So in case he had, let's say, 10 rupees of equity share and he's getting 5 rupees, 3 rupees, 2 rupees, then he will have a capital loss which he can set off against some other capital gain in future. He can claim that loss. In case he is getting 11 rupees, 12 rupees against that 10 rupees, then of course he will have a capital gain. Apart from this, when we talk about creditors will not frequently have any capital gain per se, because they are not holding any security which is a capital asset under the Income Tax Act. Sandeep Kothari ji is asking, will Section 178 apply to voluntary liquidation? We are required to close voluntary liquidation in 90 days, and Section 178 has waiting time for 3 months. Our understanding is that in
Yes,
170
yes,
proviso,
yes.
which says that nothing in this section is applicable if it is contradictory to what is prescribed in IBC. So in case IBC says that yes, there is a process which is already defined for the income tax to be to participate in the voluntary liquidation process, then those provisions will override 178. But yes, there are certain provisions in 178 where the liquidator is required to file a return of receipt and payment before the income tax department, through which he can also claim the TDS which is deducted, if any, against the company. 178 also then, so those provisions, as long as they're not contradictory to IBC, I think will stay. We cannot say that they are also, finished off.
In in voluntary liquidation under IBC, first of all, there will not be any waiver of any liability of the company, including taxes. So 178 of the Income Tax Act is fully applicable to voluntary liquidation cases. It is not applicable to the liquidation under IPC, where the company is in default, because in that case, the priority of the statutory liability is already defined. However, in the case of voluntary liquidation, Section 53 is not applicable.
Then we have another question that won't cessation of liability be adjusted against brought forward losses? So of course, cessation of liability can be
Yes.
adjusted against brought forward losses. I will tell you the issues. So the issue is that in case the brought forward losses are not pertaining to the last 8 years, let's say the company has been in sickness for about 20 years, 25 years, then the problem is that although the balance sheets that are available or in the previous years, what the promoter has done is that he has already written off all the assets. He has already created those brought forward losses, but because those brought forward losses are older than 8 years, they are not available for set off with this cessation of liability. This is a practical issue that we face. Unabsorbed depreciation, there is no life, but yes, this is a problem. Second problem that comes to us is that even if the losses are not very old, the returns are not filed. So in case the returns are not filed, brought forward losses are not available. Third issue, that even in case they are filed wrongly, they are not filed accurately. So those are issues. Sometimes we have come across companies where the issue with respect to their sickness is so old that you cannot even find returns for those periods. In case today you go to an income tax portal, you will find returns starting from financial year 2006 7 7 8. So these are the returns that are digitally available. But if you want to file returns, find returns which are older than that, that will be a tough job anyways for anyone to do. So these are the difficulties that we face, and for which, of course, we kind of then keep exploring, keep understanding, keep discussion with our partners, keep discussion with other tax professionals who are themselves legends in this area, and we find some solutions based on which the companies, the people who are taking over these companies, are able to mitigate their tax liability. But yes, in case somebody asks me that what can change in this budget, we have an upcoming budget on 1st February 2025. What relief would we want from the Honorable Minister of Finance with respect to IBC? We, on the other side, also see many companies or many entities which are publicizing and talking about how a company has brought forward losses, and that brought forward loss can be used by a buyer. There are some models which are floating around on that also. And these are typically those entities where the assets have not been written off. So the idea is that the moment somebody acquires these companies under resolution plan or under liquidation as a going concern, they will then write off those assets and create that loss. So in some of those companies where the companies have been funded purely from the investment by their holding companies, the losses can be as high as 2000 crores. But long term, whether it is a feasible option for somebody to, for the income tax department to accept the idea that somebody bought a company under a resolution plan or bought a company under liquidation as a going concern, and spent, let's say, 5 crores on the company, and now is using 2000 crores of brought forward losses, will not be acceptable in the long run. So one idea that I think is, it's pretty nice, is that this anomaly that, okay, brought forward losses are available, not available, all this are the deeds of the previous management normally. So the new management can come into the picture with a clean slate. They can kind of then, of course, say that, okay, this is what we have paid to the creditors with respect to this company, and they can be then allowed to claim depreciation on the assets which are worth that much. If they realize all those assets and they realize more than what they paid to the creditors, maybe there can be taxation on that incremental realization. Maybe some new way of structuring this entire process, that you kind of create a cutoff date, which is the implementation date for the resolution plan, and say that any losses or gains that the resolution applicant makes after that date is what he has to pay tax for, and anything that is prior to that date he will get protection from. This would be, of course, best for resolution applicants who are not looking for an overnight gain in terms of brought forward losses, and at the same time who want to take over a company without the risk of getting tax notices in future.
I think very nicely concluded, and I think we can now conclude this session.
We have one raised hand. I believe we can just allow Mr. RKG10 at Rediff Mail to talk, and then maybe we can close. We have, if you can unmute, you can share your question. Mr. RKG10 at rediffmail.com.
Since we are
Never
already,
mind. Yeah, I think we
yeah,
can close then.
I
I
think we
think.
can close that.
Thank
Thank you
you.
very
Thank you.
much. Thank you
Thank
very much. Right,
thank you.
thank you.